everybody. This is Alan Elman, the Blue Collar Investor, with today's covered call question of the day. And today's question comes from Roni. Alan, I bought Netflix on 4/20 at $141.60 and sold the Netflix 5/19/17 $145 call for $2.46. Now, today, Netflix is trading at $157.05 and the call is at $12.75. Question: would you unwind and make $516 or wait 3 weeks and probably make $586? And it's signed Roni. Well, certainly this is a great situation to be in, because what we have here is a trade that has maxed out its return in just 1 week, leaving 3 weeks remaining in the contract. So the question remains, is it in our best interest to close our position with 3 weeks remaining? Does it make financial sense to do so? Let's start off by reviewing Roni's trade. Roni bought Netflix on 4/20 at $141.60 and then sold the out-of-the-money $145 call for $2.46. On 5/1, when the email was sent, Netflix was trading at $157.05 and the call had moved up for a cost to close of $12.75. So let's take the information and first figure out how much unrealized profit Roni has at this point in time. And we feed this information into the multiple tab of the basic or elite version of the Elman calculators. And you could see here that the return on the option or RU was 1.7%. That represents the premium of 246 divided by the cost basis of 141.60. Now, upside potential represents the amount of share appreciation that can be achieved if the price moved from 141.60 up to the 145 strike. And of course it did so, and then much more. So that appreciation represented, and that was $3.40, represented an additional profit of 2.4%. So at this point in time, Roni has an unrealized profit of 4.1%. So the question remains now, is it in our financial best interest to close both legs of this trade and invest that cash into a new position with 3 weeks remaining in the contract? So how do we figure that out? Well, what we figure out is what exactly is the cost to close, but not the entire cost to close, the time value cost to close. Because the way the position is structured, the shares could never be worth more than $145 as long as that option obligation is in place. But if that option obligation is removed, then the share value will then move up to the current market value, which is $157.05, an additional $12.05. So when calculating the time value cost to close, what you do is you take the premium, which Roni informed us was $12.75 to close the short call position, and deduct from that the share appreciation we're going to benefit from if we do remove the option obligation, and that's the $12.05. So that net results in an option debit of 70 cents. Now, on a cost basis of 145, which is what our shares are worth at this point in time, that represents less than 0.5% of our current share value if we closed our position. So that's how much it costs us to close. So the question that we ask ourselves is, can we generate more than 0.5% in the remaining 3 weeks of the contract? And on the surface, that sounds pretty easy to accomplish. Now, as a guideline, and you don't have to use the same guideline I use, I like to get at least 1% more than the time value cost to close. So what I'd be looking for here is a new position that would generate more than 1.5% in the remaining 3 weeks of the contract to make it worth my while. So that's what we do. We go back to our watch list, and what we do for our premium members is that we update our watch list on a weekly basis. So if you do need a replacement stock, as you would in this case here, you have the most up-to-date information. So you take a look at the watch list, you do your calculations, and see if any of those securities can generate more than 1.5% in the remaining 3 weeks of the contract. More than likely, you'll have several candidates that will accomplish this. So let's summarize here. Closing both legs of a covered call position should be considered when the time value cost to close approaches zero. Now, one of the characteristics of a deep in the money strike, or stated differently, when share value appreciates significantly, as it did in this case with Netflix, is that the time value component of the premium starts moving towards zero, as it did in this case here. So what we do is we look to generate more than 1% of whatever that time value cost to close was, and then it makes sense to initiate a second income stream in the same month with the same cash. In my books and DVDs, I refer to this as the mid-contract unwind exit strategy, and you'll find this along with many other examples in both versions of the Complete Encyclopedia, in the Exit Strategy DVD program, as well as the Covered Call Writing DVD program. So there's lots more information on this strategy in many of our other educational products. If the calculations do not make sense, if we can't generate that 1% more than the time value cost to close, then we don't take action. We just leave it as is, and then as we approach expiration Friday, we make determinations whether or not we should initiate a rolling strategy, as long as the strike is still in the money. So it doesn't make sense to initiate these all the time, but again, the guideline we use is, can we generate 1% more than the time value cost to close in the remaining time of the contract? In this particular case, with 3 weeks remaining, I would say absolutely yes. We're going to find candidates that can accomplish this. But again, that's something that you have to refer to your watch list, look at the candidates, do the calculations, and make your decision. It won't take that long, but it's actually a good problem to have, because even if no action is taken at all, as long as the share price remains above 145, in this case, Roni has generated a 4.1% 1 month return. Not too bad. Roni, congratulations on that great trade. I hope you have many more like that one. And of course, I want to thank everybody out there for taking the time to watch this video. Hope you enjoyed it, and more importantly, I hope you benefit from it. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.